Hi, in this video of Know It Olly, I ELI5 hedge funds. So a hedge fund is a company that invests on behalf of other people, their clients. They take people's money and they go into the market and they use that to make more money. Originally, hedge funds were used within the market to hedge or get insurance on an existing position. If you were to buy a large position within the market, then you would buy something that's exceedingly cheap that goes in the opposite direction. So just in case your stock starts to go down in price, you have hedged with something that will go up in price. So that way you can clear out your position before too much damage or too many losses have been taken. To do this hedging through these hedge funds, they used to be restricted to things like treasuries and bonds, that they couldn't go and just purchase anything they wanted. However, in recent years, that has changed. These days, they are far more actively managed, which means that someone is taking your money on a daily, weekly, monthly basis, and they are entering and exiting trades trying to make money. And these days, they're literally allowed to buy anything. They want to buy coins, like specialty coins or anything. They can buy coins, they can buy property, they can buy stocks, bonds, treasuries, they can buy property, governments, politicians. I mean, when you've got that much money, pretty much anything's on the table, right? So this has kind of been able to happen and progress in years because there's been little to no oversight in the hedge fund industry for quite some time. Looking back at history of the SEC, they probably should have done a lot more. We're hoping for better things in the future from the guy that's just taken over, but we have to see what he does. Hedge funds have access to massive leverage, like massive. For every dollar that they actually possess, they can get up to $100 to spend within the markets to buy products. This is part of the way that they're able to make a profit, is that they're using leverage or money that they don't own to make money. This allows them to employ some pretty aggressive techniques and the ability to throw their weight around, their weight being billions upon billions of dollars. Because of this lack of oversight, the huge leverage, the aggressive techniques, and the fact that they've got rich clients they want to keep, it's led to some pretty flamboyant numbers in the past and some pretty creative accounting. To get into a hedge fund, they typically have a minimum buy-in. Even for small hedge funds, you'll likely have to be making over $200,000 a year to even qualify for their first item on their checklist of whether you can invest with them. With that money that you do send to them, you will immediately have a percentage knocked off in fees. You're also going to be charged a percentage, typically around 20%, of all the profits made for the year. Now, a lot of these guys at these hedge funds make some pretty ridiculous bonuses, and just remember that money does come from somewhere. Once you've got your money into a hedge fund, it's actually really hard to pull it out. It can take 1, 3, 6 months, maybe a year sometimes to pull things out. Or in certain cases, companies will put a limit on how much you can take out without an extreme fee. And that's hedge funds. I hope I made that simple enough for you. Thanks for joining me. Know It Olly out.